Dario. Welcome back to F.A.C.E. How are you?
Hi there. Yeah, not bad. It's certainly exciting times, so that's something.
Yeah, may you live in interesting times, as the Chinese say, right? So, what's top of mind? I know there are a lot of things to talk about. What are you mainly concerned about? Is this liquidity crisis with the banks going to drag on for quite some time, or are we close to buttoning it up, which I doubt?
I think that's difficult to say. I mean, at the moment, my focus is very much on central banks and whether they're losing control,
Okay.
because we came into this year and they had this very clear sort of mantra. They were going to keep monetary policy quite tight. It was all about higher for longer, and they wanted to have this sort of controlled, gentle
Yeah.
disinflation. These central bankers, they're all control freaks. They believe they can sort of finely tune the world. And then they've been sort of run over by what's happening with the banks and with this very aggressive tightening in financial conditions. And I think
Yeah.
at the moment it's really difficult for them because I don't think they have a true sense of how tight monetary policy is right now. They can see what's happening with the banks in the US. They can see that these banks are probably tightening credit conditions quite quickly. That could have, quite a big effect on small and medium-sized companies that are much more sensitive to bank lending. And so you've created this sort of big extra monetary squeeze that these central bankers weren't expecting. And they really need to get control of that now, because otherwise they're not going to have any sense of, they're still going to get the disinflation, because obviously if you have a serious sort of banking crisis, you get disinflation, but you lose control of that process. And so I think, right now these central banks are sort of caught between this horrible dilemma, because on one side they've been totally fixated on this sort of ghost of the 1970s. They're very aware
Yeah.
of the mistakes that policymakers made in the 1970s
Hmm.
when the economy seemed to be slowing, and then they would ease policy quite quickly, and then the inflation would linger and then come back as the
Well,
economy
you
recovered.
know what, Dario? Maybe in the 70s, guys that were running a book for a bank used a chart and didn't stay wrong for a year when the Fed is clearly telegraphing what they were going to do and pull a Nick Leeson with their banks.
I mean, that's true. I
I
mean,
think that's a sickening part of it is,
you
it's, go ahead.
I mean, you can't. I mean, you can't really have any sympathy for what's been happening. I mean, the bank should have seen this coming for a while. But I think if you're a
And
central
we
bank
all
right
suffer,
now,
and we all suffer from mismanagement. The only thing that anyone could ever control in this business is risk. And they did nothing, and then they get bailed out for being negligent. It kind
yeah,
of
but I
pisses
think
me
the
off.
other side of this dilemma is that central banks themselves have this sort of post-traumatic stress disorder from 2008, and they think that the slightest sort of problem in banks will quickly sort of get
Morph.
amplified, and they'll get this reflexivity, and then it'll all kick in and they'll be back facing, what happened in 2008, which in this environment is sort of ridiculous.
Yeah,
But
you
that's
don't
the
think this
dilemma
is,
that they have. It's
yeah,
sort of
yeah, yeah.
post-traumatic stress disorder versus 1970s ghosts.
Well,
And at the
they've given
moment,
me post-traumatic stress.
well, yeah, I mean, I was sitting on the RBS trading floor as 2008 sort of erupted, so I have a bit of that too.
Yeah,
And I think that at the moment the sort of the stress disorder is winning out, because they're
yeah,
clearly doing everything they can
yeah,
to try and get a handle of financial conditions again, even if that means going too far. Even if that means doing some kind of QE and calling it something different, even if that means bailing out banks in the extreme, even if that means cutting interest rates. I think that they're very much fixated on preventing those sort of dynamics from happening again.
You know what's
And
scary? These are the blue chip banks. All right, these are not your mid-sized banks, community banks. These are the blue chips.
yeah,
Pretty ugly chart. This is where people are transferring their money to. I mean, how much more comfortable should we be with these?
not exactly. I think in the end, all of these banks will be bailed out, and we're not going to get that sort of dynamic kicking in. But at the moment, this is very much what central bankers are focused on, trying to control this process. And even if that means sort of taking their eye off of inflation for a bit, I think that's where they come down on this. I think that, that the template is probably the Bank of England, because, the Bank of England sort of went through this. I mean, it was a bit different because it was about pension funds,
Yeah.
but they had the same issue.
Well,
They
that's
had this.
next year.
Well,
I mean,
they had this
how come?
dilemma
I mean,
between.
who didn't own bonds when we were at rates that we haven't seen since the Civil War? I mean, they all own bad paper. They're all down on their paper. Pension funds, communities,
It's the whole financial sector.
municipalities. Huh?
It's the whole financial sector is
Yeah.
sort of been caught out by this idea that interest rates were going to be at zero forever, that central
Yeah.
banks sort of perpetuated, and then it's all sort of unraveling. And
So what
so,
do you think happens now, Dario?
well, I think what they want to do is get a handle on this. I think they will. I think even if that means sort of bailouts and asset purchases or whatever, I think that's very much their focus. And so, I don't think this is going to sort of lead to some, much deeper financial crisis. I don't think this is going to cause a sort of gut-wrenching recession. I think we're still a long way from sort of big job cuts, particularly in the US. There is still massive demand for labor. The demand for labor has basically gone up for 3 years now, and the supply of labor has gone down. So you've got this massive excess demand for labor, which you could take out just through job vacancies. So you could destroy a lot of demand without actually causing companies to start laying off people and to get a sort of classic recessionary dynamic. I think we're still some way from that. But I think that what this is going to force on these central banks is gradualism, because that's exactly what happened at the Bank of England. The Bank of England was very, very hawkish, very, very aggressive. Something started to blow up in the financial sector. It dealt with that problem quite quickly. It used a sort of version of QE to do that. And then it kept interest rates higher, and it kept hiking, but the extreme hawkishness that it had before had gone. And suddenly it was all about sort of very gradual tightening, talking down market expectations for the terminal interest rate. So I think that's where we go. I think, that sort of extreme chasing inflation, raising interest rates aggressively, I think that's gone now. And I guess, I've always been in the sort of secular reflation, not sort of 1970s style reflation or inflation, but gradual. I don't think we're going back to 2% inflation. And I think the way that central banks are dealing with what they're seeing right now sort of confirms that, that sort of 3-4% inflation is probably the floor now, rather than the ceiling, which is what it was before. They were always trying to get inflation up to 2. Well, now I think they're always going to have a very different type of battle, which is that inflation always threatens to break too high.
Okay. Well, then, from what you're saying, will the market be able to make new highs in the 10-year yield, even if we still work lower towards 3.20 or even 3%? Do you think this is going to be some type of high at 408 that we're not going to see for years? What could take us back there if the Fed is done?
For sort of 18 months. But I think that this is a sort of secular bear market in bonds. I think that we're seeing these massive swings in yields, which are all about sort of recession risk and sort of inflation worries. And the pendulum is switching very quickly from one to the other. And we've got this massive sort of distorted economy. Central banks have amplified the volatility of their economy because they really freaked out about inflation. They raised interest rates very, very aggressively. We're at the point now where they seem to have overdone it and are now sort of switching back the other way. So you're sort of retracing some of that bear market in bonds, but I don't think we're going back to sort of previous lows. And I think what we're going to have, for the next sort of number of years is higher lows and higher highs over time. But it's a very volatile economy. And if central banks pivot too hard, then they'll quickly have to pivot back the other direction. So we've got this sort of policy-induced volatility on top of what was already an extremely distorted and sort of noisy economy because of all the distortions from pandemics and wars and all of the other stuff.
Okay. So, geo stuff is not your wheelhouse, is it, Dario?
No.
Okay. I'm going to ask you about it anyway. because I know you pay attention to it. You have to. So I mean, the whole world is focused upon whether or not the Fed will pause instead of being focused on Russia and China are not pausing. Do you think we're gonna have some blowback from what seems to be recent developments in that war? That people have to be concerned about the fact that we could be escalating. No one's really talking geo much
Well,
anymore
yeah,
when
I
it
mean,
comes to the market.
I don't think that most investors are really thinking about what has changed over the last few years. So they're very much focused on sort of very short-term
They have
economic
recency bias.
cycles, very short-term policy cycles.
Okay.
We know that when the Fed pauses, typically, equities jump sort of 20% quite quickly. And so that's been the complete, focus of everybody. And I think that, when you look through all of the big noise and distortions of the last 3 years, because, I've said before that I think this whole cycle has been a sort of head fake. It was never a sort of normal organic business cycle. It was all about, government manipulation and intervention
Yeah.
and central banks sort of pivoting one way and then the other.
Did you
But when you
watch
look
that
through all that
Frontline
noise,
special? Did you watch that Frontline special
no,
on PBS? They have one on, basically the Fed. Very good. I,
no,
I I was surprised they didn't have you in there asking you about this too, but
I check it
uh,
out.
check it
But
out.
I think that when you look through all of these sort of this fake sort of business cycle and all of these distortions, there is some stuff that's changed. Supply chains. We're never going
Yeah,
back to the
right.
supply chains we had before. We have clients at some of the big shipping companies. They tell us that they're having these sort of wild conversations about how trade is going to get rerouted in a way that they'd never had before. And then geopolitics is the other one. We now effectively have this Cold War between US and China. We have a hot war in Europe. And that's going to change the structure of the economy. Big defense spending is now here to stay. Rapid energy transition in Europe as it tries to get away from Russian energy. Protectionism, sort of strategic
Yeah,
intervention in commodity markets,
yeah,
semiconductors. It's a different world. If you think about the last sort of 40 years, it was all about neoliberalism. It was
yeah.
all about sort of trying to minimize the role of the state. It was all about free markets, or supposed to be about free markets. It was all about central banks sort of finely tuning the economy and fiscal policy not really playing a big role, or that was
So
beginning to change over time.
we're headed to the opposite polarity now.
And this is part of the long super cycles. You've had three long super cycles. You had one from sort of 1870s to Second World War, and then you had the Second World War to the 1970s, and then you had the early 1980s to 2019. Those are the big super cycles for inflation and interest rates. They're all dependent on politics, on the sort of balance of power in the economy, the balance between labor and capital. Sort of 19th century was all about capital, globalization and small governments, and capital was completely dominant. And then after the Second World War, we had this big political shift towards labor. So we had trade unions, we had
Yes.
protectionism, we had the welfare state, we had all of that stuff. And that led to the stagflation of the 70s. And then from the early 80s onwards, we did everything we could to try and ensure that the 1970s would never come back. And that was neoliberalism. And the basic sort of tenets of neoliberalism have gone, because we're emerging from this crisis in a very different world. And then when you look back at these sort of big super cycles, it's always something like a war or a pandemic, or some kind of big global historic crisis. That's
Shock.
always the thing that marks it. And I
Yeah.
think we're so fixated on these short-term policy cycles and very short-term moves in yields that we're missing this bigger picture. And that, I think, is going to be the theme for the next sort of 5-10 years.
Do you think that there are going to be bail-ins as this banking crisis unfolds? Or are they going to bail out are they going to try that? It seems like they're trying everything, like, like in the Credit Suisse example, normally bondholders get bailed out.
I
But
think
this
that
time,
I
yeah,
think that they're quite scared of doing those.
yeah.
Yeah, if you look back at the Euro crisis, when they tried to bail in investors, it led to these sort of amplified issues and problems.
Well, I'd
I
be
just think
upset.
that they're going to backstop the entire system. They're going to say that the sort of universal deposit insurance, I think, is coming probably
So
quite
is that
soon.
one step closer? I
I'm
talked to
surprised they haven't
Joseph.
done it. I
Is
thought
this
it was,
one step? Yeah, they may. Is that one step closer to uh, the biggest monetary story since Bretton Woods of the CBDCs? Is that part of it?
well, I think you need to think about what is the problem with the banks. So for the last sort of 12 months, we've all been looking at the financial sector, wondering what was going to break. And weirdly, nobody was really looking at the banks because, the banks were the cause last time. And we thought that regulation had sort of dealt with that problem. And when, the problem started in Silicon Valley, I mean, that seems sort of, we should have seen that coming because, these banks, they had massive exposure to sort of to zero interest rates. They had these big
Yeah.
depositors that were all tech companies. They were massively exposed to interest rates going up. Then they'd been buying sort of MBS and government security. So that made them sort of doubly exposed to interest rates going up. And then, as those problems in small banks have sort of escalated, then people have taken money out of the small banks and put them into the bigger banks. And that sort of escalated the problem. But ultimately, as you said at the start, this is about duration risk. It's about investors getting caught out. And when you look at banking in general, clearly there are those exposures there. A lot of these banks have been buying bonds. But also the other part of this is that all of these banks have been writing fixed rate mortgages. And policymakers have looked at that and they've said, well, these fixed rate mortgages are really good because it means that interest rates going up isn't going to squeeze households. Well,
Right.
sure, but somebody's getting squeezed and it's the banks. So the only way the banks can deal with these problems, the losses they're making on their bonds and the losses that they get from having written all these fixed rate mortgages as interest rates go up, is they have to screw their depositors. They have to keep deposit rates very, very low. And that's becoming increasingly difficult because there's somewhere else you can put your money now. You can put it into US treasuries, you can put it into, lots of other different higher yielding assets. And so, the banks are getting squeezed because of this dynamic. I mean, that's a dynamic
I
that isn't
thought
going
the
to go
banks
away.
really, I thought the banks really didn't hold mortgages anymore the way they did in '08. That, they would do the loan, but they just farmed it out into some product. They didn't keep the mortgage on their books. Am I wrong?
With the banks that we're talking about, which are the sort of small and medium-sized ones, I mean, most of their assets are some form of mortgage.
Okay.
They've been massively involved in commercial real estate. So that's the other
Well,
sort of structural
yeah,
problem for these banks is that the commercial real estate sector is now getting killed. If you look at vacancy rates in offices, they're going up for really obvious reasons. Nobody's going to the office.
yeah. You're
And
not in
so,
an office right now, are you?
no, I'm at home. So you
Yeah.
have
See,
this.
we all are.
I tried to avoid the office. So you have
Yeah.
this at the moment you have this liquidity problem which they can deal with very, very quickly just through deposit insurance. And then you have this longer term issue which is about the assets that these banks hold, particularly the smaller medium-sized ones in the US, and that is largely about commercial real estate. And again, none of this is surprising because the IMF, which is never sort of head of the curve on this stuff,
Yeah.
published this big financial stability report 2 years ago looking at the commercial real estate globally and
Yeah.
saying, this is the big risk from what's happening right now. And
Yeah.
it's US small and medium-sized banks that are most exposed to this. So none of this
Right.
is surprising. It's taking time for people to realize. And at the moment, I don't think that's the sort of dominant concern in markets. The dominant concern is just the liquidity risk.
Are you
But
surprised how well the markets held up during this scenario? I
no,
mean, we did
because the
this,
a lot of the
semi,
US
they like the,
market
yeah,
is
go ahead.
just an interest rate play. So as the
Right,
terminal interest rate has come down, all of the
right.
stuff that got absolutely hammered on the basis of higher interest rates, for the past 12 months is all retracing. So ironically, it's stuff like US tech that is coming back.
There you go.
And that, that I think there's something about the psychology of stock investors there, because I remember at the start of COVID, I remember having, conversations with clients who just kept saying, just remember, the stock market is not the economy. And for large parts of the stock market, the only thing that matters is the discount rate. And that's basically the way we've traded for 3 years. The sort of value versus growth has just completely traded with interest rates. And so as it's become clear that the Fed and these other central banks are going to have to at the least pause or perhaps cut interest rates, the terminal interest rate has collapsed and all of this stuff has reflated again.
Okay, let's make a headline. What does the Fed do tomorrow?
Well, it looks like they're going to do 25 because they want to make a point. It's almost
they don't want to show panic, do they? Doing nothing.
It's central bank of virtue signaling. That they're trying to show.
What do you call it? Central bank what?
Virtue signaling.
Virtue. Oh God,
they're trying to prove that they're trying to prove that they still care about inflation, that they're still focused on the economy, that they're still there to sort of do their job for the public. But behind the scenes, they are bricking it about what's happening in the banking sector because that is their constituency. They deal more closely with the banks than anything else. So I think that they will try to make that separation between financial stability and price stability. It's completely fake and artificial, but that's where we are. They'll do one more token interest rate hike, for the sake of signaling that virtue, and then they're done. And then they'll be trying to, they'll be hoping that these issues in the banking sector start to ease. They'll be hoping that this doesn't lead to this big credit crunch for small and medium-sized enterprises. And if they're wrong on that, and that stuff does start to, become a more serious problem, then they'll be cutting interest rates.
And they're also going to hope that crude stays down here and doesn't rally to 100, because that would bring back inflation issues big time. I'm still paying $5 a gallon.
At the moment, we haven't seen the sort of big reopening in China effect on commodity prices. I think that a lot of that is sort of backlogs. So, if you look at Chinese people booking flights internationally, it's sort of gone through the roof. So that's coming, that sort of travel and, particularly air travel and sort of Chinese demand is coming, but it's just taking longer than people thought, because we thought we'd just be seeing Chinese people everywhere as soon as they reopen. But a lot of people have had their visas sort of expired over the last 3 years. It's going to take time for them to get on those flights and for that to start to affect commodities in the way that people were expecting. And so that could come later. But at the moment, that's not the focus, I think, for central banks.
Okay, well, everybody, Dario Perkins, in the middle of a banking crisis where people are freaking out, with his calm demeanor, has told us that really not a lot to worry about banking-wise, and that the artificial economy is just going to have to make adjustments to the malinvestment. Is that the takeaway, Dario?
Yeah, we could be in for a sort of tricky few weeks. I think that, central banks are still sort of fighting the fire here. But I think when you look at what's happening in global banking, this is just so different from 2008. You just don't have that sort of systemic risk that was there before. You have a risk of deposit flight in smaller banks, but that should be pretty easy to fix. And I think, the really important thing here is that central banks went through this in 2008 and they do not want to go through it before. So whatever they have to do to backstop the banking system, they will do that. And if that means higher inflation for the next sort of 6-12 months, they take that, because it's the better of two evils. The inflation problem is there, but it can wait.
Yeah, inflation's like cancer, and we just had a heart attack. So you treat the heart attack.
I think that's where the focus will be, for sure.
Do you like that medical metaphor?
Yeah,
It'll work for you. You can use
Yeah,
it.
no, I think it's right. I think that's the way that they'll be thinking about
Okay.
it.
Anyway, I'm getting palpitations now, so we better wrap. We better wrap it, bro, before I'm face down on my keyboard. Just kidding, Dario. Really love talking to you, and you really you calm me down. I think anyone that hears your voice, you'd be an excellent central banker. You have a way.
Is that an insult or?
Huh? What's that?
I take that as an insult. I'd be an excellent central banker.
You can, but I mean, you would calm down the public anyway. So,
Oh, I know, I'm
uh, and
joking.
and I really appreciate you, giving us your time and coming here every 3 months or so and dropping a dose of sanity on us in a crazy world. Thank
No
you,
worries,
Dario.
always a pleasure.
Dario Perkins, everyone. You want people to follow you, right? At Dario Perkins on Twitter.
Yeah, please do. That would be
Any
good.
Anywhere else?
No, that's the best place to start. So,
Okay.
I tweet a lot. I post lots of sort of charts and links to analysis. So that's a good
Okay.
place to start.
Okay. Thank you, Dario, very much. Appreciate your time.
All right,
And
take care.
I'll talk to you in the summer. So Dario Perkins, everyone, at Dario Perkins. And thank you for your attention, everyone. Get ready for the Fed, know your levels, react to the reaction. And you could join the team in 17 minutes on the morning edge. Most of all, everyone, just, realize how fortunate you are to be a speculator and not have to worry about, can you pay your rent this month? Keep your perspective and don't just count your pips, count your blessings. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.